From a tax control framework perspective, for setting up risk-based controls, the more unusual the transactions, the greater the tax risks. Examples of such non-routine, significant business transactions are the migration to new jurisdictions, the setting up of a centralized business model, outsourcing activities to an internal or external shared service center, and merger and acquisition. From risk-based controls, the question is whether these non-routine transactions are properly executed from a tax risk perspective, and what the conditions for success are to make that happen. If VAT actions are not designed and implemented in time, it could not only result in financial, but as well in commercial risks. It is important that you understand the business model, the absolute amount involved, the VAT complexity, and the impact of change. That means understanding the key numbers and thus the VAT numbers under management. These are impressive enough to get the proper attention of senior management. In this example, the VAT number, excluding the bad debts and realized savings that needs to be managed, exceed at least 3.6 billion euro. An error has a direct impact on EBITDA, which is an important business KPI. A mistake of 1% impacts shareholders' value. This simple table shows how important it is to manage VAT. If the reason of a business model change is to optimize the company's effective tax rate, minimizing cash tax effects or cost reductions, or realize efficiency overall, it is important that with regard to managing such change, the indirect tax function is timely involved. Indirect tax issues should be addressed upfront during the design phase for proper implementation and executing of indirect tax planning. Any change has impact on current processes and controls and its effectiveness. Business model change, such as a centralized operating model, results often in an increased number of transactions and indirect tax obligations across many jurisdictions. Important is to ensure that the new operating model is not only implemented correctly from a corporate income tax perspective, but also ensures that business processes are indirect tax aligned, realizing support of the business in the areas of compliance, finance and accounting, legal, IT systems, and regulatory matters. That means teaming with these various work streams is a necessity. In practice, EP configuration, the amount depends, is needed when companies deal cross-border and complex business models are set up, such as a centralized principal structure with, for example, a limited risk distributor or commissionaire. The principal bears contractually, from a business deal perspective, the major risks. Principals are in the main rule still owner of the goods when these are sent to customers. For corporate tax reasons, such principals have their residence in low tax countries. Commissionaires only act as intermediaries to the customers. The principal pays them a commission fee. In a strip-buy-sell model, not an agent but a reseller, a limited risk distributor, also known as an LRD, is part of the supply. The difference with a commissionaire is that the reseller becomes owner of the goods. VAT treatment for commissionaires and LRDs are in principle similar, by cell, but with different legal flows. From a VAT perspective, the commissionaire is deemed to be owner. LRDs and commissionaires have neither legal ownership to the inventory during storage nor during transport, as the principal is at that stage still the legal owner. Different accounting rules exist for LRDs compared to commissionaires. It is often the case that the principal delivers the goods physically and directly to the final customer, a so-called drop shipment. This creates only one physical departure of goods issue, in the ERP system. However, two invoices should be raised. One from the principal to the LRDs or commissionaire, and one from the LRD commissionaire to the final customer. In the ERP system, the correct ship from information at the LRD and commissionaire's level is missing, so that the VAT treatment by the system is determined based on the ship from and ship to information present at the principal level. For cross-border transaction, that often results when SAP is used in an incorrect VAT treatment. Therefore, in practice, it is not easy to correctly configure the tax determination logic setup. A sales principal located in a non-EU country will create more complex registration and trading issues. Some questions about the new structure in VAT. Will using a classic principal structure in a new entity help keep maximum profits in low tax jurisdictions? If so, one entity will own title to inventory throughout the various jurisdictions, and the principal would require a VAT registration in each location where inventory is held. Where will the regional inventory hubs be located? Careful planning of the hub locations will allow VAT on import to be deferred to a point where it no longer represents a cash flow cost to the business. It is important that the steps of the migration are carried out in the most VAT effective manner, subject to commercial and other factors. Some questions that could give some guidance are: how is the tax function involved in the legal structure and transactions? How is the tax function involved in operational changes in ERP implementation and cost reduction? Who is taking care of filing of the VAT registration? When should you apply for VAT registrations, since average lead times in jurisdictions can be several months? The migration could result in that ERP systems have to be updated and tested to reflect new contracts and billing flows. Ownership of these tasks must be determined and communicated upfront, so that the ERP system can accurately issue invoices from day one. A best practice is that VAT is considered in every aspect of the migration process, from concept through completion and beyond. It is all managing change by design, looking at every process and transaction, from start to finish, and factoring in all the requirements and controls, essential to designing and optimizing a compliant VAT process. Phenix Consulting is a company led by 6 partners and a team of around 30 employees. Our main business focus is to optimize SAP from a tax, financial and control perspective. We have offices in Amsterdam, Berlin and Cologne. We hope you enjoyed this webcast and hope to hear from you soon.